Thanks so much for joining us today for this one-hour seminar focused on insurance industry regulatory changes. As many of you know, RGP has significant experience helping companies plan for and execute on accounting changes. Over the last several years, we have been living and breathing those changes focused on revenue recognition and lease accounting. Much like the revenue and lease changes, the IFRS 17 and long-duration targeted improvements requirements are extremely complex, and they will impact underlying business processes, systems, and data. RGP is pleased to join forces with Superior for today's seminar. With that said, I will turn things over to Dave Christensen, Insurance Solutions Leader at RGP, and Eduardo Dalma, Global Lead in IFRS 7 Solutions at Superior.
Thank you so much, Tracy. This is Eduardo, and it's my pleasure to be with you today. The agenda that Dave and myself have prepared for you today will contain the initial situation, trying to understand where we are as an industry facing these regulatory requirements. We will then dive a little bit deeper into those changes that LDTI as well as IFRS 17 is really forcing on us, two very prominent regulatory requirements that are currently heating the discussions in our industry. And then we will finish the seminar with some ideas on how you can mitigate some of these risks, how you can work on it and make your life a little bit easier. With that said, let's dive right in. We start with the key steps in your journey. This, I would assume, may not be new to you. Every time a new regulatory requirement shows up, you technically start with an impact assessment, trying to identify how will it impact my business, where am I with these respective requirements, and how do we want to tackle them? What kind of implication can I expect on my processes, my people, my data, and my systems? Once you have gathered the necessary evidence on how you would like to proceed, a targeted approach will determine how you will basically answer those questions in your particular company. You may also need to enhance existing systems processes. So you may work on a new target operating model. You may run into a selection so that a solution that may help with some of the calculations may ease the necessary requirements. And then ultimately you will pick a solution, start to set up a program, and then run into an implementation, including the design, the migration of the data, and then going through the testing to make sure that everything works, and then ultimately go live. This is kind of a journey that I would assume all of you have seen. We have been, for the last 20 years, part of the majority of these journeys. And what we would like to discuss with you today is the question, what if we could basically get to a point where we don't have to restart every journey in the same way? Because every regulatory requirement comes always a bit like a surprise. And we always have enough other things to deal with, specifically in the organization, and therefore the resources are never sufficient in order to tackle all these topics. We sometimes have competing regulatory requirements that happen in parallel. And so the question for today will be, what if we could basically anticipate some of these topics? What if we will be prepared from a systems perspective, organizational perspective, in order to tackle these elements without really going into a crisis every time we face new regulatory requirements? That said, let's move on and see if you look into the mission of the majority of the regulatory programs that are out there, and I'm speaking here predominantly for the IFRS 17 ones. 80% of the insurance industry is predominantly focusing on compliance. That means we want an MVP, minimum viable product, that will enable us to comply by the requested due date, and that's it. Approximately 10% will also use this as an opportunity to improve from an operational perspective, which means that while you are in your implementation, you may also tackle some other things and try to automate some data provisions or try to change some of the processes on how you approach this from an organizational perspective. And only 10% really focus on a transformative approach, saying, okay, this one is a big one. We've been looking at this for many, many years, and maybe now is the time to tackle it, and we will basically embark into a full transformation in order to not only comply with the requirements, but also to have in the end something that will help us with the next requirement or the next requirement. I don't blame you. 80% is compliance. Some of these new requirements are so complex that it doesn't seem like the right time to go into something transformative if the resources are not sufficiently there, if you don't have the time to really deal with it. But I think part of the problem that we're facing every time we embark this type of journey is exactly the fact that we try to comply and do not use the opportunity to really improve our processes, to improve our systems, and to improve our data in a way that we will be more robust and stable the next time that something hits us. Why am I saying that? That some of these requirements are not getting easier. So if we move on, Dave, you will see that the majority of these new requirements, like LDTI or IFRS 17, have a focus on the future. So they are focusing not on what were the actual results from last year and how do we interpret evaluation of a specific number. They really deal with the fact, how can you basically determine the future and prove that your future statements are basically true. So they want to see how good can you manage that type of look into the glass ball. And if we want to do that, we need to involve completely different players than the ones that we usually had on any of the regulatory requirements. We need to work much closer with the actuaries that operate on a completely different type of granularity level, that have a completely different focus when they look at the data than we would have, for example, from a finance perspective. We do not only look at the actual process on how we get to the close, but we also need to incorporate forecast and planning and potentially also some simulations, because we need to stress test specific dimensions of our calculation in order to comply with some of the regulatory requirements. That requires a much more holistic approach. When we look into the processes, we need much more alignment. It will impact the way that we operate as an organization. So we will have change management elements. It will require to look into our systems, because the connection between the actuarial systems and the accounting systems, the claims systems, the finance systems have not been always there. The granularities need to be aligned, and all of it needs to work together, and all of it needs to comply to fast close requirements. So all of that is basically making your life much more complicated as we move on, and therefore the need to really take a pause and really think about, how do we want to approach it instead of just using the regular journey is right now. So that brings us to the first polling question, I guess. So, Dave?
Yeah, thanks, Eduardo. So again, hi guys, this is Dave Christensen, and I'll be reviewing here the poll question. So really we want to understand, because we know that there's a multitude of companies on. There's really big companies, there's small companies, and we just want to remind you that this IFRS 17 or this LDTI journey is not new. You've done this before. You've done it with RevRec, and leases in the most recent past. So we were just wondering, based on those frameworks and those processes that you established, do you think you can use those with this new compliance initiative? So you've got the gamut. You can say, gosh, it didn't really impact me last time, so I don't know if I'm going to use, like insurance companies, the RevRec one didn't really impact you. But we were interested in where you think you might be able to leverage those past experiences. And we're already getting poll questions back. Oh, we've already finished the question. So we see that most folks are saying, yeah, it looks like there's some utility to what I've done in the past, but this one's a little different, so I'm going to have to retool and maybe refine that. But it looks like we have a good base for what we need to expect. So thanks, Eduardo. I'm going to take us now. Let me close that poll. Into LDTI, and I just want to put some frameworks down here so everybody understands. We're talking about two initiatives today, and at one point, you might remember, they were one initiative. So back 10 years ago, the FASB and the ISB were joined at the hip in trying to create a worldwide insurance standard. After some consternation and deliberation, the FASB decided to move off of that and say, ISB, you go forward and you create your model basically for all your IFRS filers. We're going to take a step back and look at, we're comfortable with the models we have. We know they're not perfect, so we're going to take a step back, value the models. Some of you P&C companies might remember that first change was a couple years ago, gosh, more than that, 5 or 6 years ago, where they expanded the disclosure requirements regarding claims experience. This is the second piece. There was lots of, again, I said the FASB didn't say we had a perfect model. There's things we need to improve. And so now here we have some improvements to the existing model. It's not like IFRS where you have a completely new framework. This is a modification of the current standard. And right now, we're looking at effective dates for public companies as of January 1st, 2022, and private companies as of 2024. I will tell you, if you guys haven't seen it, the FASB, these dates take into consideration the extension that FASB has already proposed. So they did a 1 year, from the initial standard, a 1 year extension for privates and 1 year for publics, I apologize, 2 years for privates. So that's the deadline you're looking at for, Eduardo will talk about the IFRS 17, but you have a complementary 2022 effective date, again with an extension for both publics and privates on the IFRS side. So let's look at the standard and actually what they modified. And there's really 3 areas where they looked at, and that very first one was the biggest criticism of the old FAS 60 model was this locked-in assumptions. And some of you guys might remember that that old FAS 60 model came from an AICPA standard, which was really based on how life insurance contracts are priced. Meaning when you price a contract, you look at the initial inception, what all your assumptions are for the life of that contract, and that's how you price it. And back then they said, gosh, if we're going to price it that way, let's account for it that way. Now that created some inconsistencies and conflicts with other standards where we have more robust updated assumptions whenever we initial financial statements. So this new standard, this LDTI, this targeted improvement model, requires you to remove that locking provision, and all actuarial assumptions are updated at least annually. Some people have said, gosh, does that mean I have to go hire 10 more actuaries? Well, I don't think so, but there definitely will be an increased level of actuarial involvement in your reserve estimations. The other thing they said, there is no explicit provision for deviation or PAD. You might remember we did all these calculations, we figured out what our insurance reserves would be, and then we put, say, whatever your confidence level, maybe an additional reserve on top of that to allow for that adverse deviation. So FASB has now specifically told us no explicit PADs. I've already talked to a lot of companies that are going to go on, well, maybe I'm just going to bury that back into my initial actuarial assumptions, maybe with a different confidence level. I said, that's fine. That's up to you to establish your best estimate, but no explicit pad. The other big change, and I know a lot of folks don't like this one, is the discount rate. We're moving away from the insurance expected returns or what they expect to earn on those assets they invest to back those liabilities. We're now moving to what we do in pensions, where we're going to use basically a AA corporate rate to account for that. FASB wanted to do that one. They wanted consistency. Again, that one I think is fairly controversial, and a lot of folks aren't going to like that. There's going to be some accounting complications with the result of that. Now changes in discount rate, because remember now we're unlocking, so we're updating that discount rate every time we, at least annually. That change in the reserve isolated to the change in the discount rate does not go through earnings, it goes through OCI. So it's easy to say, more complicated when we get into the model and how you're going to bifurcate that change in the discount rate and the reserves associated with the discount rate and not track that through the P&L. The next change, so that was on the insurance liability for DAC or deferred acquisition costs. Some of the accountants might like this one because I know in a lot of organizations, the accountants are responsible for DAC amortization and impairment. Because don't have locked-in assumptions anymore, and we're updating our assumptions anymore, the DAC impairment test has gone away. And it's been replaced with a more simple straight-line amortization. So we don't need to look at profits emerging or any of those patterns that we did under the old model to defer our acquisition costs. And then finally, I think a more mild one, all market risks are now in scope. In the past, we had a couple different measurement models. Really, this is respect to those investment type contracts with significant insurance risk. We're now going to remove the two models. A single model is going to take all the market risks into scope, and all those market risks are going to flow through the P&L. So this is a great summary of kind of where we were and where we need to go. And a lot of people ask me, well, gosh, based on what you've seen so far, some of these look like simplifications or improvements. What have you seen so far? And I'm not going to delve too much in the technical accounting or the methodologies. I really want to focus, and this is what Eduardo was talking about before, the technology and the data components required for this analysis. So I think this is a great opportunity for a lot of companies on the phone to say, take a good look at what your technology is today and what your solutions are today and say, is this an opportunity for me to take a homegrown system and go and try to replace it with some external system? And if I do that, how many wires are going to have to unplug and then replug? Some folks might be on a current, like Moody's, reserving or valuation model. I know a lot of companies are on that, and Moody's is updating their assumptions or those models to include the new assumptions and disclosure requirements. And then the other thing I really want you to think about, and where we've seen some complication, is really in the data. There are some simplification efforts regarding the transition, whether you can't go back. Some of us might have 30, 40-year-old whole life policies sitting on our books, and whether we can go back and get some transparency into those original contracts is pretty complicated. So there are some remediations available to us, some things we can do, but really the data and the availability of the data from those past contracts. I think of the two pieces, the accounting. Again, the accounting is not that complicated. It's more simplification, updating assumptions, but really in the technology and the data area. And when we talk about IFRS 17, you're going to see these same things. This is not this U.S. GAAP standard. The issues that our insurers are facing are similar to what the international folks are seeing on the IFRS 17. I just wanted to at least give you some highlights or glean some information regarding what we've seen to date. So that will take us to the next polling question. And I think this is one where a lot of people will look at this and go, gosh, Dave, you make it sound easy. You show me one slide with all the changes on one slide, but it's not that easy. There's other things I'm worried about and I'm concerned. So where are you concerned? Those folks that are impacted by the U.S. GAAP change, is it with your resources? Do you think you have the adequate accountants or actuaries or IT support or to submit this thing? Are you worried about the accounting? Are you worried about your system? Are you worried about your data? And then lastly, I'm not gonna make any actuarial jokes and make fun of any actuaries if they're on the line. But how are you going to involve your actuaries into this project? And everybody's different. How their shops are set up. Some have internal, some have external, some have a whole line, an easy line of communication between the accounting department, the actuarial department. Because we know in life companies, it's an effort. It's a coordinated effort. The actuaries are on the right side, generally the accountants on the left side, but they got to talk to each other. So there's the results. Not surprised, honestly. Like I said, that the accounting and actuarial involvement ended last. You guys must work in companies where you have lots of happy hours with your actuaries. My experience isn't that in every respect, but resources, it looks like, where most people are concerned. So now that we've kind of delved into LDTI, I'm going to turn it back over to Eduardo to talk more about IFRS 17. Eduardo?
Yes. So where does IFRS 17 actually apply? I would say just very broadly, nearly everywhere except in the U.S. The U.S. is only impacted if you have companies abroad that are part of your group, and then the question, of course, is there, do we need to support them in creating the IFRS 17 results, and how will we deal with the results then as we do the consolidation? There is some level of choice in certain countries. In Japan, for example, you have the choice to go with JGAAP. I think even Canada, where the majority of the insurers have basically to comply, except they move to US GAAP. So there's also kind of an exit there. But in general, I would say everybody has to comply. What is interesting about the IFRS 17 standard is that it has predominantly been started out of criticism of the insurance industry. And then over the course of the 10 to 15 years, depending on who you ask, that it's been in development, it changed into being something that should make the insurance business more attractive for investors. So I will guide you a little bit through the activities that we need to do for IFRS 17, and then we should have included that actually as a polling question. You can basically answer me whether you think that this is something that investors will now understand and therefore buy much more insurances. So as we move on, let's quickly look into what the standard is actually requesting from us. I think in 5 steps, right? So if you look into the IFRS 17 standard, it all starts with a new way of grouping your business. The IFRS 17 standard defines a unit of account, which is at the level that you basically do your calculations on, as a similar risk managed together with policies not issued 1 year apart from each other, which means that you can use a market category, an actuarial segment, potentially as a starting point, but then you will realize that you need to group your business also into categories like we believe this business is profitable and will stay this way. We believe this part of the business will be non-profitable, And then there's also the third category, which is related to business where we don't know whether it will be profitable or not. So you need to mark all these elements and group your contracts in that particular way, which is already a challenge in itself because as you may have, sometimes a combination of products and you would like to amortize certain earnings in a different way, you now have to determine whether you split those elements into 2 units of accounts, which technically would mean that you have under one policy or one treaty now suddenly to account for it in 2 different models. For all of those that are longer than a year or at inception onerous, which means that they're non-profitable, a new measurement model has been determined, which was initially called the building block approach because it has specific building blocks to get to the calculation, but I think it's now more known as the general measurement model, which you see on the left. So it technically requires you to collect all your fulfillment cash flows for all your future view, so which means that the premiums, the claims that you anticipate to earn with your product over the lifetime of the servicing. For a life contract, it could be a very long time. And then provide that at initial recognition. If it is a subsequent measurement, meaning if it is something which you have already issued like a quarter before, a year before, then these fulfillment cash flows should also include all your actuals. And so now we get also to the tricky part, right? So how do we align these actuarial segments with the actual data out of our claims and technical accounting systems so that all of it can work together? These cash flows, of course, since they're future related, need to be discounted in order to reflect the value of the passage of time. And on top of that, you have the option to use a risk adjustment. I say the option because you can apply it on the claim side or the premium side or both. The IFRS 17 standard is not very demanding in the sense of really telling you what to do. You have a lot of possibilities for interpretation. And then it's kind of a discussion between you and your auditors whether they will accept your approach or not. And as you put together your fulfillment cash flows with everything that is anticipated, everything that you have as an actual, you discount it, you do the risk adjustment. In the end, you get the contractual service margin, and this is basically now your new figure that you present on your balance sheet. So it's not related anymore to premiums. It's now related to the actual margin that you will earn with this specific unit of account. And that, of course, changes the entire storyline. So how do we interpret our results? What is what we tell investors? What is what we tell the market out there will completely change. You still have the option to move into something which is more likely to be like today, which is the PAA approach. That PAA approach can be applied if your business is not longer than a year, so it's predominantly for P&C business. But in the case that it becomes onerous again, right, so you have to run this test independent of the model that you apply, then you need to calculate a loss component. And in order to determine the loss component, you need to calculate also the GMM, because then you need to create the delta between both in order to get the loss component. So when you thought it would be easy to just take that shortcut, they built in a couple of elements in there to still keep it a bit more complex. At the end of the day, balance sheet and income statement are impacted, of course. They are in a simpler way now, because remember, this was done for investors. But we have earned now a series of disclosures that will require to explain everything that you did and why you did it. So going back into some type of comparisons, when you do the initial recognition, you lock on basically all your assumptions, including also the discount rates that you use. If in the course of the year or the second year you should change those assumptions, then you always have to calculate the delta between the locked-in rate and the new rate, the new assumptions and the old assumptions, and then these disclosures will basically show what was the reason for you to change this. Was it a change in assumptions? Was it a change in discount curve? Was it a change in economical reasons? So all of that is basically listed, and you have to explain each of them in general. As you can imagine, finding your ledger accounts is not that easy now with this new evaluation, so subledger function also needs to be adjusted. And then last but not least, of course, your general ledger may be able to digest the IFRS 17 requirements out of the existing chart of account, very likely, and in the majority of the cases that we see out there, it will not be able to do it, so you will need to create also a new chart of account. Where do we see struggles out of the current implementations? And remember, some of these implementations are reaching already the second year around this time, is the alignment of data, which is a nightmare, because the systems that we're using were built for specific purposes that did not basically take into account IFRS 17. And therefore, trying to align all these different data models, specifically the actuarial and accounting view with each other, is kind of very complex. These fulfillment cash flows also contain now directly attributable expenses, which need to be determined and aligned. So we technically use those out of the GL. So I'm talking about non-insurance expenses. And you need to now also allocate them down to the units of accounts. And remember, it's similar risk managed together, so it could be a set of policies. It could be one actuarial segment, but it could also be an individual treaty, for example, if you're dealing with a large life reinsurer. So there's a lot of flexibility in terms of what is required there. So last but not least, of course, as I mentioned, this will require you also to change some of your organizational structures, because the actual numbers are now basically hitting the balance sheet directly. So you need to create the necessary steps in order to guarantee your checks and balances, in order to make sure that all of these things work together. Last but not least, you have a possibility to open your balance sheet through what the IFRS 17 standard calls the transition. You have three models. The first one is anticipating you have been using IFRS 17 since inception. For the majority of our customers, it means that they're missing data in order to really do that. And then you have two additional approaches, which are a bit more facilitated, but this is also a big challenge. In terms of the timing, 22 is the actual go-live date. As of 21, everybody has already to report IFRS 17 on a delayed timeline in addition to IFRS 4. And so the majority of the projects that are starting now have technically a year in order to align all of these elements that I just mentioned, and then technically go and test the system. What we think is the most challenging piece is to get really the data to run, because independent of the vendor solutions that you see out there in the market, they basically only perform these calculations based on the rule book that is associated with it. In order to really determine for you your new story, in order to determine whether your granularity is right, in order to determine whether this is what you want to present out there in the world, you need to get the data as quickly as possible into the system. And this is where we are urging, to get all these connections done as soon as possible, in order to really be able to determine, let's say, the final design as you see the numbers in your system. And that's, of course, a challenge if you look at the timeline that is out there. And then last but not least, this has a huge impact on your closing process, because you need to combine much more data than you need to do for IFRS 4, which technically takes you into the question, how can we automate the majority of the data provision in order to be able to comply with fast close requirements. So this is in a nutshell kind of the request from an IFRS 17 perspective. So you could tell me now if this is really then easier. Oh, we're missing a slide. Can we go one back? Oops. Yeah, exactly. Okay, so now that we've spoken about, these are the challenges, and the majority of you by now, I think, are very well aware of it. Let's talk about, how can we actually mitigate some of these activities and how can we make your life easier. And one thing that I want to present to you is what we call an integrated finance and actuarial architecture. The rules behind this have started technically from all the experience that we've gathered over the last 20 years, but I think the starting point for it is basically what you see on top, everything which is related to integrated reporting. So we took the idea of how do we gain the majority of the flexibility for your management reporting as well as your external reporting, and how do we need to build an architecture taking this as the starting point. This is our final result, and go back through the consolidation into the GL, into all the systems, and basically determine what is the flow of the data, does the underlying process look like, which function do we need when. So this has been the starting point because we believe that this is the place where you really will need the flexibility in your reporting. The other part is also to align the master data, the business rules, and the processing support. So a very, very relevant item because we have in the majority of the system landscapes that we see very partial support for that. It's all very fragmented for the and all geared towards one specific topic, which is the respective element that you want to cover and that step of your transaction. And so these rules are more covering the entire end-to-end process, and this is also where we spend the majority of the time now adjusting. What I will present you now is basically a vision. It does not mean that it will solve your problems immediately, but I promise you if you start to work and change your journey from going every time through the evaluation and doing every change in order to just comply, you will never get a result that really will help you with the next one and the next one and the next one. So it's kind of a journey. It's a vision. It requires courage. It requires patience in order to get there. And so let's step into the details now. We have split what you see on the left-hand side is basically all your source systems. And the majority of the implementations that we see do not want to change anything on the source system side, and I get that, right? So, and the technology today, in the majority of the cases, enables us to do so much with the data that is there that you don't need to go back and create new fields in order to comply with the standard. So let's anticipate for now that we won't change anything in the source systems. That requires us to have an inbound staging that will be able to massage, to work on our data, ensure that this data gets the necessary attributes so that it can continue with the calculation. We've spoken about the challenge from an IFRS 17 perspective, right? So as well as from an LDTI perspective, you need to align actuarial data with accounting data. You have multiple source systems, and in some of the cases we have more than 40 systems, right? So that puts an emphasis on this inbound staging. We've tried, I think, in the past to align some of these items through business warehouse technology, but there's so much more happening on the ETL side that it's definitely something of interest. And just one word of advice, right? So the majority of the vendors that offer you LDTI solutions as well as IFRS 17 solutions tell you that they have an ETL function, but ultimately they always want from you a clean data source, right? So for IFRS 17, for example, give me your cash flows and then I will take care of the rest. So very simplistically said, right? So because that puts all the effort in changing that data onto you, right? So think about this as this should be something that you own because this would be a very relevant element in the entire calculation. The next thing, and this is kind of new in all these architectures, is technically to work with engines. These engines cover business rules that we have in a central storage in the cross-functional layer. And these engines will enable you to determine a business rule, take the input data, and then create one version, right? So let's say the IFRS 17 version or the LDTI version. So it will enable you to potentially reuse cash flows that are produced in a similar way. It will enable you to use yield curves in a very robust way in order to create these views. The big advantage of an engine is if a new requirement comes along, you just basically change the business rule and then you have a new result. So this is kind of the idea behind this. And now we need to, of course, connect all of this with the subledger. And this is one of the most trickiest pieces because the subledger needs to operate now potentially also for multiple accounting standards, right? So you're doing potentially IFRS 17. You also may have to do LDTI as well as US GAAP. Some of you have also to cover US a Solvency II requirement. So the subledger now becomes an integral part because it has to be a smart subledger that can use the results out of the calculation engine and find the right ledger in order to populate those numbers. So this is another big element. And then you move basically into your GL, and as you can see, right, so with all these elements that we've listed here, the question is now not anymore, how many dimensions do you cover in your GL or not. So that's only relevant if you really want to use your GL as the posting basis for everything. But with this combination of the inbound staging, the engines, and the subledger, you are basically creating the majority of the details that you need. And as long as you have a reference data that shows into the GL account, you will be able to execute all the drill down functions. This architecture will also enable you to compare oranges and apples, right? So if you need to draw comparisons between US GAAP and, let's say, IFRS 17, it will enable you at least to pick those elements that are kind of similar and basically compare them with each other. And the good thing about this is if you integrate your processes and functions on top of it, you can basically determine which functions to use for which element. Remember that I spoke about the forecast, for example. You could run now your forecast at the same level of granularity as you would run basically your actual calculation for the quarter close. Why is that so important? Because, in some areas, if we need to provide these future numbers, it is so important that we align them fully, as we will not have the actual results by the time we need to really provide those reports. So you need to help yourself with aligning these elements with each other. But this is a robust basis in order to have that type of discussion on where to layer your functions and how to operate as one organization. It's not offering you now an answer on the most tricky question, of course, on how would you basically leverage your existing staff, but it is relieving your staff of doing the work over and over again for multiple regulations. So it's automating, the inbound stage is automated, the engine is automated, the subledger is automated. So it's automating some of these elements so that you can finally use your precious resources in order to concentrate on the upper part, the functional views as well as the external views, and work on the story and tell the story that you want to tell. Okay, Dave, I think the next one is the accelerators. Oh, no, we have the polling question now.
We have one more polling question. So remember, you can answer this question whether you're preparing for US GAAP changes or the IFRS changes. So I assume we're going to get different levels of involvement depending on what your perspective is. But really, we're just interested in, 17's been out there for a little bit. It's probably a more comprehensive and holistic change. So you're probably a little bit farther down. A lot of US GAAP filers are probably just now digesting the changes with respect to your insurance reserve and the new disclosures and the new models, et cetera, but we were just interested in where people are landing. I really wanted to put a fifth option on here saying, what is IFRS 17? But I did not do that. We just have polls ended. I don't see the results coming through just yet. There we go. So pretty well distributed from beginners all the way through fully defined plans and et cetera. So interesting. Thanks for participating. And even though that's the last polling question, we need you to stick around for the last few slides here as we kind of bring this all to a head. So Eduardo, I think this is a great kind of a last place to land as we look to see, in those projects, those IFRS 17 projects, those LDTI projects that are currently in place or planning to be in place. Where are we seeing, the drags, the overruns in those project plans? So why don't you take us through a couple of these?
Sure. So one area of risk, of course, is that some of these standards are still evolving, right? So you have a basic idea of how it is, but then they're still in discussion, specifically on the IFRS 17 one. There's still a huge discussion on some of them, and they have a transition group that is dealing with them, and the minutes from the transition group basically determine how to do things. So that means that you have a moving scope in your project. So how can you deal with that, right? So what has shown to be really practical in the majority of the implementations is to use an agile approach. It does not mean that all of the teams have to work agile, but at least those that are dealing with the elements that are directly impacted by the standard should work with it. I know it's an additional challenge for some of you, but I think it's also an opportunity because the agile principle also enables you to operate with the last item that we have there, the limited resources clashing with other initiatives in your organization. And if I say, I really mean the people here. The way that the Agile framework works is that it gives you the opportunity to measure, the next type of cycle, and then based on the availability of people, you will then also determine the scope that is possible. The next one is the out-of-the-box functionality. So this is determined for those that are not embarking a build type of solution that they create themselves, but those that really buy something out of the shelf. The majority of these items, the majority of the vendors have pretty comprehensive solutions that cover a lot, but they are also evolving as the standard is evolving. So they may not cover everything in the first day. So when you do your selection, please look at a mature solution because that will reduce ramp-up time, basically also help you to build the necessary trust in order to make those decisions yourself. Then, of course, the insufficient data quality in the source systems. So data management capabilities will be the key success factor here. This inbound staging area that I showed you, right? So this is something that you can start to work on right now. Park in every regulatory project some money for that and continue to evolve it because that will save you so much time, right? So I've seen companies that have started to work on aligning the majority of their actuarial processes, reducing their models. All of those folks that have started with this over the last 3 to 5 years are in so much better shape now than dealing with these types of requirements. Don't forget that you need a lot of time to test because this is about your storytelling. So make sure that you plan that. And going back to the vendors, use a solution that has a white box approach, meaning that you can really see what are the calculations that are in there in order to determine, which is the best solution. Because then, the time for you to understand how it works and building that trust in order to make those final decisions is so much easier to do. And there are vendors out there that are very open with that, and there are others which are not. So put that into the list of things that you need to look at from a selection perspective. It's 12:50.
And Eduardo, I think I would add
for the questions.
Well, I just want to add one comment on the evolving IFRS 17 LTDI standard. So obviously IFRS 17 is a largely principle-based standard, and a lot of those TRG discussions are people are just wanting more clarity. Nobody likes rules, but there are some areas that they need some additional guidance. So that I will wholly encourage, and we saw this when we did RevRec. The standard came out, and there were 6 amendments. Auditor engagement early on in those IFRS 17 engagements, I think is very important, just to get them buy off on your accounting policies and your methodologies, because you don't want to build something that at the end of the day the auditors are going to not agree with. On the LDTI, I'm not seeing that so far. There is some interpretation regarding grouping of contracts at a seriatim or a cohort level, and what's the best way. Where you end up and where you start might be the same, but there are some complications there. But again, I think we have a little bit more time on that one. It's not as comprehensive, but auditor engagement in that one as well. So yes, you're right, Eduardo, and we've gotten a couple questions. I don't think these are, I'm not going to blindside you, Eduardo, but there's a couple here I think I want you to address. The first one, and I'm really not surprised to see this one, because I think as consultants, the number one question people always ask us is, what are the best practices? What are the things, the best way to do things that you're seeing out there in your experience? So on IFRS 17 engagements, Eduardo, what do you think about that?
So I think I've listed a couple of them in the accelerators, right? So I think just to repeat them, the agile principle, some of the elements that you should look at when you do the selection on the tool. But if there is something that I'm learning through this IFRS 17 topic, is that there is no such thing as a best practice, because everybody has a different starting point, right? So you may have a very sophisticated actuarial engine already in place. You may have no actuarial engine. So that changes the entire approach, right? So you may have a very strong accounting foundation. You may already have engines. So that all changes. So every time that we're going through this type of analysis and trying to find the best solution, it is always, for me, like a start from scratch. It makes it, of course, very interesting. But, of course, it is also, I think, to a certain extent, very, very complicated. And I think this complication will just continue to grow. That's why we need to approach it with agility from an organizational perspective, with an open mindset, and also a readiness to really throw away things that we have in order to make room for other things.
Yeah, I would agree that, and I think it's even compounded in the insurance industry, where there are some very similar companies if you're doing basic P&C, life and auto, but especially when you get on the life side, it's really hard. The book of business and the way people organize their data and organize their contracts and do the pricing is different from company to company, so it really is difficult to find those best practices or similarities between the companies. All right, I think the next one's mine. This one is, I've seen this one before. I made a joke earlier about the actuaries, and I'm not going to pick on them. But the next one says, is the LDTI initiative an accounting or an actuarial exercise? And what I would tell you, because a lot of people look at those and they go, gosh, that's insurance reserves, that's actuarial, that's not I'm sitting on the controller's department. But I'll tell you, it's neither. It's both. It is a great opportunity. Like I said, take your actuaries out for a happy hour, get to know them, because it's going to take a coordinated effort to get this LDTI. The core data is going to come from the actuaries, but at the end of the day, the controllers own the data, and you do own and need to drive your disclosure requirements. So it's not an either. It's both. It's a coordinated effort. That's how I would answer that question. Okay, last one's yours, Eduardo. So we've already seen a delay once from the ISB, and we've heard lots of, I'm adding this, we've heard lots of consternation in the industry about whether they have enough time. You expect to see another delay, and if I haven't started, if I'm in that early stage impact, do I have enough time to finish before the 1/1/22 effective date?
It's a very good question, and I think it's a bit looking into the glass ball, right? So because nobody knows what the ISB will do. Up to now, they've been very, very tough on really moving the dates. They don't want to see something happening like what happened with Solvency II. So I would for now anticipate that the dates hold. If there is one thing that may shift is the comparison period that starts in 21, right? So I think they could basically retain their phase and skip that without really having to move the due date. Do you have enough time for those that are starting now? So I'm operating a lot in the Canadian market, and I have to say they really have guts, because the majority of the European implementations have started, as I mentioned, 2 years ago, and these guys will be ready right on time. So starting later will maybe give you the benefit of more clarity in the standard and a more mature solution that you purchase. But it will not solve the problem of really going through the data and telling your story, as well as basically aligning the data provision into these systems. So unless you really have a very robust engine there and solutions that you've put in place already through the prior regulatory requirements, I would urge you to really start those projects because there's so much that needs to be determined and explained. There's so much to learn, right? So for the entire organization, that you really will need the time. The technical piece could potentially be simpler, right? So you might get there in a year without having to stretch it, but then understanding what is the outcome of that calculation will likely take also some time. So please consider that. It's not just a technical exercise. I think the biggest impact is really on the people side.
Okay. Well, thanks. And I think you said, but I'll remind people they might do on the deferring. They won't defer the effective date, but they might do what they did with RevRec and remove that comparative requirement and make it a prospective. In essence, like contracts open, they'll be accounted for, under the new standard on a prospective basis as of the effective date. If they do something, I think they might do something like that. So I think you mentioned that. I just wanted to emphasize that matter, and we've seen that in the more recent past. So I think that's all the questions I have at this point. And it looks like we're right on time. Gosh, you would have thought we practiced this. So any concluding comments, Tracy?
No, I think that was great. Thank you both so much. Well done. And we'll have follow-ups with everyone that joined us today. Nicole, am I missing anything?
Not at all. Thanks so much. As everybody logs out, the CPE survey is going to appear on your screen. Certificates will be emailed within 2 weeks of the session.
Thanks, everyone.
All right. Thank you.
Thank you.
Thank you. Have a great day.